All right, guys, let's look at Goldman Sachs. What is the expected move here in Goldman Sachs? Anybody? Okay, anybody besides Tim? Okay, David, Mick, thank you. I have it as about $6.60. Looking at the 177.5 straddle being, 40 cents in the money. So let's get a whiteboard going here. Stock equals 178. Expected move is about 670-ish. Puts us at an expected range of 171.30 up to 184.70. Okay, so on the downside, there really is no sort of support for this stock other than the, kind of where we traded down to at Christmas time. This stock has really been in a free fall. The only thing I see to the upside is where the 50-day moving average is, which is up almost around 187-ish. So in terms of technicals, I don't see a lot of support and resistance here. Which kind of tells me that if we're not looking at a particular direction, if we were looking at, let's say, an iron condor, that sort of type of play, it would have to be pretty good conviction in terms of reward to risk, because technicals are not playing into it here. So we would have to find something down around these ranges of, the 171 and 185 area, at least at even odds, if not better. So this $2.50 wide iron condor, even if this were at $1.25, I'd be skeptical. Let me put this up on the whiteboard here. So the 172.5, 170, and 182.5, 185 iron condor is trading about $1.15. So first off, the reward to risk is under 1-to-1. But then looking at the break evens, okay, we're looking at 171.35, which is right there to the downside, but to the upside here, we're only looking at 183.65. So if I compare the break evens here to the expected range, I'm not to that width. I've got to get at least 1-to-1 odds on this, if not better. So I would not want to do this. Everybody see what I'm talking about there? So let's look, another possibility when we look at a potential setup that is non-directional would be a strangle swap. So let's look at the 170, 185 to see if, from a volatility standpoint, there's anything there that makes sense. So that thing costs about $1. Okay, not a bad looking chart. Not a bad looking chart. Not overwhelmingly great, but not a bad looking chart. When I say not bad looking, if you look at the P&L at the bottom here, you know, you've got positive P&L all the way down to 166 and change and up to 188. But if we're paying $1 for this thing, I got to see a little bit better reward to risk on that. Everybody see what I'm saying here? So let's just try something here. Rather than an exact strangle swap, let's go out and make this a diagonal strangle swap. So where we're lowering our put and call, lowering our put purchase and raising our call purchase next week to see if that looks any better. Okay, so now we've got something where this is about a zero cost, but we certainly have some risk if this thing moves outside of the expected range here. So we've got a really nice window here. Okay, a really nice window of profitability right here, but if we get that outlier move, we have some pretty undue risk. Right? So if I compare that P&L to what the expected range was, the expected range being about 171 to 185, that's, you know, that's right where we're coming in with profitability. So that looks really good. But again, if we get an outlier move one way or the other, I personally think there's too much risk for this. Everybody see what I'm saying? And do you know what I mean by when I say an outlier move? Outlier meaning beyond the expected move. Yeah, exactly. Exactly. So if we're within the range, the profitability looks great. But if we're outside of the range, then that profitability gets to a pretty bad loss. So I don't like that. So I think for right now on Goldman Sachs, I mean, I don't see anything directionally I'd want to do. And certainly the neutral type play, the iron condor strangle swap, not lining up so well. So we'll keep it on the board, but for right now, nothing that I see. Okay, if you guys don't have any questions, I'm going to take this off. I'll get the video posted in the room, and I'll be right back. Good morning, Peter.